With a U.S. presidential election on the horizon, many retirees and soon-to-be retirees are wondering how this might affect their financial future. Election years often bring heightened drama into our lives as political opponents duke it out, but does all of this really matter? Because at this point, a good number of us would probably just prefer to put our heads into the sand and wake up when it's all over. The real question, though, is how will this hit your retirement plan? After digging through the data, it turns out there are a few surprising takeaways in terms of market performance during election years. And so in this video, we'll cover all of that, as well as a few practical steps that you can take to build your own election year emergency plan, just to make sure that you're staying on track with your retirement. Hey there, I'm Steve Willems. I'm a practicing certified financial planner and wealth advisor with the Willems Wealth Planning Group out here in BC. We started this channel to help you plan for your own retirement, helping you think about how to plan and arrange your investments, your income streams, and ideally pay less tax along the way. Now, these questions inevitably pop up every 4 years, and this year will be absolutely no exception. But before we get into exactly what to expect this election season and how to prepare, let's just first cover off what the data suggests about market performance in previous election years. And I'm not going to lie, there were at least 3 surprises when I reviewed this research. Now, first, the most common question that we get asked is just which party is better for the markets, a Republican or a Democrat? And of course, it's obviously more nuanced than just that single factor, right? Every single presidency is underpinned by a whole host of other factors, including kind of the economic environment that they inherit, global macroeconomic factors, productivity, interest rates, technological innovation. But the numbers are what they are, so let's just take a look at that. Now, typically, mixed control of the House and the Senate means more roadblocks to either party's agenda. And this typically would lead to slower change or just no change at all. And since the markets tend to be afraid of uncertainty, the status quo might actually be welcome news. Now, this chart shows how relatively infrequently there's been a mixed Congress. In either case, it's impossible to identify any trends when zooming out and looking at the bigger picture over time, as long-term investors actually should be doing. It turns out the stock market is not the economy, and the stock market is not the White House either. But according to this data from Y-Charts, going back to 1950, the mix by political party in Congress and the White House that yielded the highest average annual returns for the S&P 500 is technically a Democratic president with a divided Congress. Now, this admittedly is a small sample size. So what if we go back further and look at it a different way, this time by annualized U.S. stock market returns during the different presidential terms? Now, in this case, we can go all the way back to 1929 and see the following data. So here we see only 3 presidents in nearly 100 years of history have experienced negative returns for the S&P 500 on an annualized basis over the course of their terms. The average annualized return for a president's term was 9.5% based on this data compiled by Dimensional. Now, what about how the market behaves in the year of an election? You'd think that surely with all of the sensationalized headlines, be it today via social media or 80 years ago by kind of actual newsprint, that the markets would take that uncertainty and reduce those returns in those election years. A BlackRock helpfully actually ran this analysis, and they found 3 pretty wild takeaways. First, they looked at the average market return in election years versus non-election years. And here's what they found. So this time, going all the way back to 1926, the average market return is showing an average of 10.3%. Now, in non-election years, so no midterms and no presidential election years, the average stock performance stepped up massively to 14.8%. This was pretty surprising to me. That's a massive change. Now, don't worry, though, that outsized return still leaves a nice premium, actually, in presidential election years, where it also steps up above that 10.3% average, coming in at 11.6% in presidential election years. Now, the downer here seems to be midterm years, which also is pretty interesting. Another way to look at this, though, would be through the lens of win rate in election years. So here we would be asking kind of the question of the data going all the way back to 1926 again. Of all of those years, what percentage did you make money or lose money? And then organize those outcomes based on whether there was an election year or non-election year in those specific periods of time. So in non-election years, 70% of the time the market was positive, while 30% of the time you had a negative outcome. So now let's just look at election years. And in election years, you'd expect it probably to be a little bit worse, right? Well, wrong. In election years, 83% of the time, markets ended the year in positive territory, and only in 4 instances did you end the year red. And while there's absolutely no guarantee that the markets will follow the historical election year pattern, in past presidential election years, the third quarter has tended to show positive momentum. Again, kind of based on this research from BlackRock. But hold up, as soon as you think you've got a silver bullet in your hand, this is another view of the same data. In this view, each of these small green lines is the monthly returns of the US stock market going all the way back to 1926. These monthly returns, when charted like this, look a lot like a bell curve. Now this graph has arranged those monthly returns from left to right by market return in 1% increments. Highlighted in blue and red are the specific months that a Democrat or a Republican won the presidential election. And of course, what you'll see here is that, well, for one, like most election months haven't produced extreme returns in one direction or the other. And two, the winning party hasn't been a reliable driver for the direction or magnitude of the movements in election months either. So before we dive into what to expect this time around and how you can actually prepare, I just really wanted to lay kind of the groundwork with this data so that we're all starting kind of from the same part of the field. So now what can we expect this time around? Well, let's just keep it simple, right? Let's expect drama. Showmanship, ridiculous headlines, thoughts in your mind thinking, like, are we really debating this? These things always tend to rise up in election years, but especially the case in the social media age in the last number of years. Just look at some of these headlines from past election cycles. Of course, the intent of all of this sensationalism is to actually stir up an emotional response in us, right? So let's just anticipate those feelings now. Right? Those feelings of worry, of concern, of anxiety. Perhaps, the political drama blurs into the markets at some point. The data suggests that could entirely happen at some point. We shouldn't be surprised if that occurs. The key is just not making emotional decisions based on these crazy headlines. So that's what to expect. But what can you do, or what should you do, or maybe think about doing to help prepare for this? How can you create an election year emergency plan? Well, 3 thoughts here. First, just make sure that you're focusing on what you can actually control in your retirement plan, right? There's a critical intersection that I think we need to focus on here, and that's the overlap between the stuff that matters over on this side and the stuff that's actually in our control over here. The things that fall in both of those buckets are where we need to actually spend our time. Now, the election is probably kind of mildly important. Some might say more, some might say less, but it certainly isn't in our control. And so I'd suggest we just attempt to turn the volume dial down just a few steps on this. It's certainly still okay to be informed. It's good to know what's going on. But the people who thrive through seasons of disruption like this, they find a way to emotionally almost detach themselves from those sensationalized headlines. They build up a type of kind of emotional resilience, like thick skin, to weather through whatever happens. So that's the first thing. Now, second, tactically speaking, now is a good time also to just know what you own, right? You'll want to look through your portfolio and identify the overall allocation to safe assets, so fixed income, cash, bonds, that kind of thing. I'd suggest actually putting a dollar value on it, like know how much dollars you have in that bucket. When I'm meeting with folks, it seems many don't actually know that number off the top of their head. It takes some kind of looking up, but it's actually really helpful to know. Now, why is that? Well, because if you're concerned about stock market volatility around an election cycle, whether the data supports that concern of yours or not, let's just first identify how much of the portfolio is actually in the market, right? Versus it just being invested elsewhere or in some other types of investment vehicles. In many cases, especially up here in Canada, where many portfolios will also hold a blend of diversified assets, but then they'll also have a home country bias kind of layered on top of that. Many of these Canadian portfolios will find that their US stock market exposure is actually much less than what they might have originally thought. Third, now that you know how much of your portfolio is in the safe stuff, you'll want to look at how much portfolio draws you'll need to fund your lifestyle in the next, say, 2 years. Do you know where those dollars will be coming from? Is it already set aside in a bucket so that however the market responds, you'll be okay? That's the key issue here, because knowing where those future withdrawals are going to be coming from and making sure that the investment plan is actually lined up with your income plan. This is a super important step, the synchronization of your income plan and your investment plan. If you're not sure how to do this, we can lend a hand and maybe point you in the right direction. I'll put a link in the description below and you can grab a retirement strategy session where we'll be able to unpack this one-on-one in a little bit more detail for you to make sure you're getting answers. Of course, it's natural for investors to look for connections between who wins in the White House and which way the stocks will go. But regardless of who wins, nearly a century of returns shows that stocks have just trended upwards over time. Of course, we'd all wish for some kind of iconic signal up in the sky that'll tell us how to navigate this specific election cycle. But the good news is that we don't actually need that. If you're planning your retirement, there's a good chance you already own stock. Stocks are just companies, and the biggest companies are run by some of the most talented people on earth. They got big, right? They found success by focusing on their customers, solving problems for customers and growing their businesses, regardless of who happened to be in the White House. And sure, presidents can absolutely impact the markets, but so can interest rates, so can the actions of foreign leaders, dictators around the world, changing oil prices, interest rates, inflation, technology advances, just to name a few. So that's all for today. I hope you found that helpful. If you did, you've got my permission to share this with whomever you think might actually benefit from it. We're really just trying to put as much good information out there as possible so that folks can really find their footing and optimize their retirement plans. Thanks again for watching. I'll see you in the next video.